Well, thank you, ladies and gentlemen, for joining us to the first Paydirt Unlocked lunch of 2021. I just mentioned to our panelists then, it looked like everybody was enjoying themselves so much in the room. We were just going to sneak out the back and go downstairs and have a couple of beers before we came up and give ourselves some Dutch courage to get up here. But we decided against it and we thought we'd get cracking. Thanks for joining us. As Bill mentioned earlier, we've got a fantastic set of panelists. I'm sure they need little introduction, but let me do so. First of all, to my left, we have Jeff Quartermain, Managing Director of Perseus Mining. Then next to him, we have Richard Hyde, Executive Chair of West African Resources. And lastly, on my far left is Stuart Gale, CEO of Resolute, or still interim? Interim CEO of Resolute Mining Limited. As you should know by now, each of them are miners in West Africa. Jeff in Ghana and Cote d'Ivoire, Richard in Burkina Faso, and Stuart in Senegal and Mali, as well as a development project that's up for sale in Ghana. So there's plenty to talk about. I've got some questions here, but please, I'm due to finish in half an hour, so you have to do the work after that for the last 15 minutes and ask some of our panelists some questions. So please start thinking about some questions now. And once you've had your mains, I'm sure you'll have the opportunity to ask. I'm going to start though, and I'll give the panelists a nice easy warm-up, I think. And Jeff, I'm going to start with you. I mean, each of the companies here on stage has been successful in West Africa over a significant period for different reasons. But Perseus in particular has been a miner there for nearly a decade now, 8 years, 7 or 8 years, I believe. Now has 3 mines operating. Is it easier to be a miner in West Africa now than it was a decade ago?
Yeah, well, look, that's a really interesting question in a way, and there's no simple answer, unfortunately, to it. I mean, I think if you look at our experience, we would say, in order to be successful, there are 5 key ingredients or 5 elements. 1 is you've got to have decent assets. 2, you've got to have decent people. 3, you need access to finance. 4, you need markets for your products, and 5, you need a social license to operate. So if you actually unpick each of those sorts of things, well, in terms of assets, yes, there are some outstanding assets available in West Africa, and the exploration that my colleagues' success have had over time is clear testament to that. In terms of people, very, very important, and we've been quite successful, I think, in being able to recruit an outstanding team of people. In fact, there's a table full of them just here in front of me, and really, really high quality. And I think one of the keys to that is having, now that we've got a multitude of operations, it's a more attractive proposition. I mean, markets speak for themselves. I mean, the gold market's doing what it needs to be doing, and the financial, availability of finance. Well, certainly debt and equity capital is available for all of us. It's a question of at what price. I mean, it's risk adjusted, the pricing, but it's certainly there. So all of those 4 things are quite readily accessible and can contribute to success. Now, the trickiest one, of course, is the last one, is the social license to operate. And I'd be the first to acknowledge that, over the 10 years we've been operating over that way, we've seen some quite significant changes in this area. And I'd be telling fibs if I said it's getting easier. It's not getting easier, but I think we're getting a bit smarter along the way. So, what was a big problem for us 10 years ago, perhaps we're able to deal with it more readily now. But I think it's a long-winded way of saying, look, yes, you can be successful, but there's a fair bit more to it than just turning up and throwing your hat in the ring. It does require a fair bit of work, and there are a lot of things that can lead you in different directions.
Thanks, Jeff. Richard, would the West African story have played out the same way, or just as well if it had occurred 10 years earlier?
Well, yeah, it's a good question. I think Jeff's answered the main parts pretty comprehensively, but one of the key parts is to have a solid asset, and what we started off with in 2014-15 it wasn't solid. It needed a lot of work. We were lucky in 2016 with the discovery that when you put the high grade zone together with the lower grade parts of the project, it made a much more robust project that's going to do over 200,000 ounces a year. So I think a solid asset will always get financed in most markets. And I think if you look at 10 years ago, going back to, West Africa was still exploring 10 years ago. We'd only just listed. But the companies like Ampella and Griffin were there, massive market caps in on the ASX, and then you look at where those assets ended up going, they weren't developed during that cycle. So they've had to wait for another cycle, and they've had to be downsized. Well, one of them hasn't been developed, the other one has. So it does come back to having a really solid project, and then you can engineer a lot of things. You can't engineer geology. So I think, and then talking to the key points that Jeff mentioned, a good deposit's one of them, and then you can backfill the rest of it.
Stuart, would you agree with that sentiment? As Jeff mentioned about being better with their social licence to operate, is Resolute a more sophisticated West African miner than it was a decade ago?
Well, yeah, I think so, Dom. I think we've been in West Africa since '98, and operated through Tanzania, through Ghana, and now operations in Mali and in Senegal. But so yes, there's been a build-up of learnings, and you've got to make sure that you stay on top of those at all points in time. I think, together with the 5 points, which are really good, Jeff. I hope someone's got a note of those. I think it's also really important that we maintain really strong relationships with not only the communities but also the governments. It's important to have the right people who are on top of what's going on within the governments at any particular point in time, because they change, and we see that in Ghana now. And you're always seeing a bit of fluidity throughout that political, the more macro themes, and you got to be on top of that at all points in time. So I think that's a learning, but it's all the learning is that you're always going to have to evolve, and you always have to go and be focused on what's going on there. But nothing beats a good asset.
Sure, I'll stay with you. In the past decade, 20 years, we've seen the ASX and the Toronto Exchange and the London Exchange compete to be the home of African resources stories. Resolute itself has looked to London. Perseus is looked to Toronto. And Richard, were you listed in Toronto at one point as well? Yeah. And each of you have tapped those markets down the years. What's the current status quo in your opinion? Is there a natural home for the African resources stories at the moment?
Yeah, look, it's a very interesting question. I think we can look at so we listed in London roughly 2 years ago. And I think the theory behind the listing in London made a whole lot of sense, and probably still does make a whole lot of sense. But you've sort of got to crack that market, and that's where I think our challenge has just been over the last couple of years, is to really create the liquidity in those markets that takes it away from our home listing on the ASX. So to be honest, we haven't seen. I expect that we will see over a period of time an improvement in the liquidity flows through the LSE, but we just haven't got there at the moment. And it's very interesting, when I have discussions with shareholders who are based in that part of the world. So, well, where do you trade? You obviously trade on the LSE. No, they trade on the ASX. Why do they trade on the ASX? Because there's more liquidity there. So it's, unless you have an event that specifically creates an LSE volume, then I think we're just going to have to be patient until we see the benefits of that listing.
Jeff, would you share that sentiment? Is it similar having a dual listing in Toronto?
Look, I don't buy the story at all. I've got to tell you, I think that it doesn't matter where you're listed. It's all about performance, and if you perform, then investors will come, right? So the fact that you might be listed in London or Toronto makes absolutely no difference at all if you're not going particularly well. I mean, the conventional wisdom is that London is the preferred home for West Africa, and this is based on the fact that same time zone, and then Australia and Canada both have vibrant industries in their backyard, so they're not particularly interested. But as I say, I don't really buy that story particularly well. I mean, people will come if there's quality, and they'll trade where there's volume. So I think dual listing just simply, spreads your volume and isn't really that helpful at all. The investment bankers in the room here would beg to differ with me, I'm sure, because they like to push the line that you should be dual listed and they get the fees off the back of it. But frankly, I'm not too sure how many there are out there, but I frankly think it's I don't really subscribe to that theory.
Richard, do you share that opinion then, given that you were dual listed and you walked away from Toronto?
Well, we managed to, extricate ourselves from it, really. It's not an easy process, and Jeff's been through it, and I did talk to Jeff about how difficult it is to get off a listing in North America. the reality was for us, when we were funding Sambrado, we'd raised money in 2017. We did our bigger raisings in 2018. And I can still remember the splits because I was involved with raising the money, and we had almost zero come out of Canada. So money came out of the US, so about a third of our money came out of the US in some of the bigger funds. But 2/3 of it was out of Australia and very little out of the UK at that point as well. And that was after the end of this marijuana boom in Canada. So all of the speculative money left mining and the gold space and really got into the pot stocks. And I don't know how much pot everyone had to smoke in Canada to justify those market caps at the time, but it would have been ridiculous, But we kind of managed to kind of get our Canadian percentage of shareholders below a level that allowed us to back away from that listing. And what it does do, it reduces compliance costs, the compliance requirements. You've got your team doing 2 sets of accounts regularly. It's an additional impost, and we just weren't seeing the benefit of that. So we were pretty happy to get off it.
So is capital more fluid then now?
Look, I think they can trade anywhere these days. Yeah. So you can get a fund out of London that can trade on the ASX, and so I think we found, the key kind of component of our last capital raising that was underwritten was about $43 million. The key cornerstone for that came out of Sydney. I think what we benefited from was the fact that a lot of the Australian gold miners have done really well. So there's this sort of elevated sort of market caps of those companies. All of the funds in Sydney, Melbourne, or mostly across the East Coast had done well, and they had additional capital they could carve a bit out of their Australian holdings and put it into the emerging markets where we are. But it still wasn't an easy raise. Neither of those raises were easy.
Jeff, sorry.
Yeah, so
Jeff, one of the compelling reasons, if you like, for chasing money or listing in Canada or London was the perception that those markets had a better understanding of Africa, and that the Australian market Australian investors always applied an African discount to any operator in that region. Does that African discount, did it exist, and does it still exist?
Well, you could say it exists, and I'm not absolutely sure whether it does necessarily. I mean, it is a bit of an excuse for bad performance at times. There's no doubt about it. I think the Australian investors are pretty xenophobic. There's not too, that's pretty clear. But I think it goes more to the point that, for an Australian investor, there's a very vibrant gold mining industry here in Australia. They don't need to take foreign exchange risk to invest. If they invest locally, they can get on a plane and come and have a look at it and touch it within a couple of hours. Same thing for the Canadians. They've got a very vibrant industry very close to home and in South America. The British perhaps are more inclined to travel. They don't have a homegrown industry. And I very cynically say, half the boys operating in the City of London, their dad was the ambassador to Botswana or something, when they were a kid, and they went there for school holidays, so they're kind of comfortable with it. I mean, that's a fairly cynical view, I must admit, but they do seem to be less risk averse, or more comfortable with African risks than perhaps the Australians and the North Americans. But having said that, we've got 40% of our share register is US, about 30% is UK, Europe, and pushing 30 is Australian. So it really doesn't matter too much to investors around the world, I don't think, if you're doing okay.
Stuart, you in the last year or so sold your only Australian asset to go all in on West Africa. Is the political risk dimension and the jurisdictional risk still one of the first questions you field from investors now that you're 100% West African?
I wouldn't say it's one of the first questions, but and again, remembering that Resolute's been in West Africa since '98, so we've been there for a long time, and the understanding and the development for the first question is obviously very important, and but it's a question. There's no doubt that it's a question, particularly from our Aussie investors. You can't dodge that question, and again, going to the point of it's really important to ensure that you understand the systems and how the systems are working in each of those countries. And very clearly, we've got a few tax matters that need to get themselves resolved. It's clear it's in the accounts, And but that's one of those points where really important to understand what you're doing and where you're going so that you can manage through that process, and that's key. But in terms of is there a risk? I don't think so. I mean, I think the reality is anywhere anyone operates, if you're operating in the mining industry, it doesn't matter whether you're operating in Australia or North America or South America, wherever, there's always something that you need to be thinking about. So resource rent tax, think about that a couple of years ago. What would that have meant to the state of Western Australia? So you need to be always on top of all of those things, but I think investors are clever enough to see through all of those in the longer term, and it comes back to how you're operating and the fundamentals of your asset base and your business. If you do well, i.e. Randgold, you can do you can generate a lot of value.
Richard, you mentioned that when you were raising money to fund Sanbrado, a lot of Australian funds had a remarkable run with the domestic gold producers, and that run did continue right up until, well, it's still continuing really, but there has been a softening not only of the US gold price, but certainly the Australian gold price as well, and all indications would lead to the fact that perhaps the Aussie dollar is going to get stronger over the next near period. Does that open up an opportunity for West African producers? Do you get on a more level pegging with the domestic producers if there's some softness in the Aussie gold market?
Well, I think investors also focus on cash flow, free cash flow generation. And I think if you have a look at some of the assets that we've got up here, that they do generate a lot of free cash flow. And that's probably in contrast to some of the Australian assets that are getting older. The underground mines are getting deeper. Certainly speaking about Sanbrado, it's a new mine. And, we generated a small profit in the first half of production for our first half-year report. We'll have our annual report out soon, and we've generated a very healthy profit in our first year of operations, and it'll get better, as we kind of get more development into the underground, and we get better at what we're doing with the operation. So there's a bit of a contrast between, there's risks in all jurisdictions, and I think probably the risks in West Africa are, they're legal and fiscal. I don't think anyone could doubt how good the projects are. The deposits are very, very good. They're generally higher grade and better than what you find in Western Australia these days, I'd say. Look, I think that's what we've got to focus on as West African producers is just generating as much cash as we can and making that the point of difference between the emerging markets or West African producers and the Australian producers.
Jeff, do you prosecute a similar argument when you're talking to investors in comparing you to Australian producers?
Yeah, there's no doubt about it. I think the thing that is appealing about, say, companies like West African and Perseus to a degree as well is the growth profile that's ahead of us, in contrast to the Australian, some of the Australians at least. And as Richard quite rightly said, our ability to generate fairly substantial amounts of cash in a relatively short period of time, I think, is very well received. And I guess the challenge then is how wisely you deploy that cash and what you do with it. That's certainly a major point of discussion with people that I talk to these days. So recognising that we're firmly on the track to be producing 500,000 ounces a year in fairly short order. There's a lot of cash coming off the back, and what you do with that, or what you're going to do with that, is a subject of real discussion.
When we're talking about cash flow and costs, we're seeing increased labour cost pressures here in the West Australian gold sector, particularly as we've seen in years before, the likes of BHP and Rio and FMG take labour out of the gold sector and back into the iron ore sector. Is there a similar situation in your operations at the moment, or are there differences?
Well, look, we're not having any trouble recruiting people, I'd have to say. I mean, I know that in West Australia that isn't necessarily the case, that there are some shortages in certain areas. But no, we're not having too much difficulty at all, and we're not seeing, massive salary increases. I mean, I guess, as I said earlier on, I mean, the fact in our situation where, we have 3 operations now and we can actually offer people a bit of a career path, that does make a difference. And the sort of people that will work in, say, a West African setting are quite a different subset to what we'll focus on in Australia. So it's not really a big issue. I mean, as to salary increases, I mean, obviously you're constantly having those conversations, and in Ghana, the Ghana Mine Workers Union, I think they learnt their stuff from the lads in Newcastle or in the north of England or something or other. They're pretty aggressive, but nevertheless, we do battle every year, and we get to where we need to be. But I think labour is certainly not. And as far as the local people are concerned, the Indigenous labour, I mean, what gold miners get paid in West Africa compared to, say, doctors or nurses or teachers, I mean, these guys are extremely well paid, and so they're not going to be. They really fight hard to get their jobs, and when they get it, they're not going anywhere. So from a local content point of view, it's not a big deal at all.
I'd just like to point out my great-granddad was on the Jarrah Miners March from Durham to London, so he'd be very proud to have heard them comments. Stuart, labour costs is one issue. It certainly must have really sharpened the focus at the beginning of the pandemic and the lockdown. Was that a major worry, losing particularly expat staff who having to travel to operations, and how did it transpire for Resolute? Yeah,
look, I think the whole COVID thing, when it started, about 12 months ago now, it created a whole range of issues. Logistics being probably the biggest one. So where you need to move people on and off sites, and they've got to spend, if they're coming back to Australia, they've got to spend 2 weeks in quarantine. So just thinking about the whole roster is actually pretty tricky. In reality, we probably actually saved on some travel costs, given we weren't moving people as rapidly as what we did. But you still got to have the attraction factor. So when you look at the export expat workforce, we've reduced that significantly over the last 12 months, and that was a conscious decision that was made because we also have a belief that it's very important, if you're going to be a long-term operator in a West African country, it's important to be bringing local talent along and getting some of the key managerial positions to become locals. And and we've done that certainly at Syama in the last when was it, November timeframe. We appointed Mohammed Sisse to run the operations there, and he's done a fantastic job. He's a local Malian who's dynamic and a great leader, will be fantastic. But we've got to develop a bit more of that, not just for the whole COVID dynamic, but because it's also a sensible and important thing to do. It saves on costs, it creates positive community support, creates government support, creates all of the right things that you need when you're operating in a different jurisdiction to where we're sitting today. So I think that's really important, and that's something that we'd certainly be prepared to spend a bit more money on in terms of bringing those locals through, because it's got longer term benefits.
Richard, were you the same? I mean, you were ramping up an operation at the time COVID struck you. In fact, you were almost caught short, weren't you, in Europe? Yeah,
look, I was on site we were planning for our first gold pour in March, it was a year ago. We'd all gone over, the mills had spun, we were feeding the mills, and we got word that the government was going to close the border, so we had to bring forward our gold pour by 4 or 5 days, and I had this thing, I wanted a big pour, I wanted to be a good pour, hold up some big bars, and in the end we said, let's just get it done and get out of here, because otherwise, we had people stuck on site for 6 months, and that's the reality of operating there. And I think Jeff was alluding to this previously, that the type of people who want to go and work overseas as expats, they're a pretty hardy bunch, and so we had people who said, no, we're happy to stay on site. We organised stay-at-home nanny services for staff whose partners were stuck off site when Victoria was in lockdown and they couldn't get grandparents in to help out with kids at home. I think mining these days is a much broader sort of business. We're not just about mining. It's a lot of facets to it, and you have to think about these things and manage them well if you want to retain good people. And 90% of our workforce in Burkina Faso is local, so it's from Burkina, and about 50% have come from the local area. So we've only got about 10% of our workforce is expatriate, and that's not just I guess European or Western expatriates. There's expatriates from Guinea, from Kenya, from Ghana, Mali, because there's it's a maturing sort of region for mining. I think there's probably been commercial mining in Mali for over 25 years now. Probably 15 years in Burkina and much longer in Ghana. Obviously, Ghana was an early mover in West Africa. So, there's been generational sort of improvement in the quality of people with regard to mining and all of the sort of ancillary services. So I think there's less reliance on the sort of Western type of expat, but you still need them, to make sure that you're doing things to a very high standard and kind of being efficient. And that's been one of my mantra has been to try and get, West Australian or Australian sort of level of work into West Africa, and that's what we did originally when we were doing exploration 10 years ago, and that's what we're doing now that we're in operations.
Jeff, I know we've spoken about this recently about the expat levels at your operations. You have seen that regional expat movement, haven't you, between different operations within the group?
Yeah, no, we have moved a few people around from our Ghanaian operation over to the other groups and vice versa. I mean, we actually only have one expatriate in Ghana now. I think, we probably employ, I think it's 400 directly and there's probably another 1,600 indirectly, but of our recruits, there's only one expatriate and the rest are local people and they do an excellent job. But we have moved people around a little bit. I mean, the sort of guys that like when I say the sort of guys, when you consider the expatriates who take these jobs, they do have a fairly limited attention span, some of these guys, and after a couple of years they decide, let's just roll off to the next one and the next one beyond that. And that's not unreasonable because if you're on site and you're working 10, 12 hours a day and you're working 7 days a week and you're working 6 to 8, it used to be in the old days, but with COVID a lot longer than that, you do get a level of burnout. And I think, we talk about COVID and things like that. I mean, I think probably the impact of COVID hasn't necessarily been felt yet in our workforce because, a lot of people are getting very tired and we really do need to be able to move them around. And I mean, airline travel is difficult. Quarantining when they get back to Australia is a challenge. And so you tend to work longer rosters. So I think, we haven't been affected. I don't think Richard or Stu's been affected too badly, but I don't know that it's fully played out just yet.
Yeah, I was going to ask if anyone had a question, but everybody's eating now, so I'll leave it until you haven't got a mouthful of food. I want to go back to, on the issue of expats, certainly the hiring of locals and localisation of the workforce. It's a key issue in a point that Jeff made early on the fifth point of the social licence to operate. I'm interested in getting your thoughts on a social licence to operate, but particularly how it's seen from an investor's point of view. The rise of ethical and investment and ESG principles has been rapid, it feels like, in the last couple of years. Can I ask, perhaps I'll start with you, Stuart, how is this rise in focus on ESG as a risk factor how does it affect your business and interaction with these investors?
Yeah, well, look, we just published our maiden sustainability report yesterday. It's an excellent read, so I highly recommend everyone having a look at it. But the team did a fantastic job in terms of getting it out. It's a serious, a serious run through all of our operations, but it's really important that we do it because it's not going anywhere, Dom. It's the whole ESG thing is gathering momentum and will continue to gather momentum and probably should gather momentum as well. I mean, I think we, as operators of business, all have an obligation to ensure that we do things the right way, and it's also important that we factor that into obviously making good business decisions. So if you can, we're almost to the end of the completion of a new power plant at Syama, and it's going to save us 30 or 40% in terms of emissions. So that's obviously very good from an ESG perspective, but also it saves us 20 to 30% from a fuel cost perspective. So a lot of that sort of stuff is going to, you can manage it together. So it might take a little bit of investment up front. But that's okay, because you should be able to receive the benefits from it longer term. But all I'm saying is that yes, investors, and you're going to have particularly green investors, or you're going to have green funds, or you're going to have whatever they are, green bonds that are going to continue to flow through. We should be getting ourselves actually into a position where we can take advantage of some of that cheap money potentially.
Could you take advantage, given that you're a West African producer? Have you got more opportunity to take advantage of those type of ethical funds than a WA gold producer might, because of the social impact that you can have?
Yeah, potentially. And I think it's a very good point. I mean, potentially you've got more of an opportunity to do that, given the potential benefits that could be derived through the communities in which we operate. And we operate in populated parts of the world, so and poor parts of the world. So, to the extent that we can bring benefit into those parts, then that's got to, let's think about it from their side of things. They've got to tick a few boxes as well, right? So it does, and it's not a box ticking exercise, but it should certainly create opportunity. Think about it from a solar perspective and putting solar plants in and things like that. So absolutely.
Jeff, we had a fascinating discussion between yourself and your colleagues Leanne de Bruin and Jessica Volich a couple of weeks ago on this very issue. Has reporting your ESG capabilities and sustainability capabilities made Perseus a better miner?
Well, I'm not sure about a better miner. See, it's kind of interesting, and I think Jessica would back me up on this, having recently joined us as head of our sustainability group. I mean, we've been doing all of the things that people now refer to as ESG forever, right from day dot, right across the business. We've been doing it, and I think that we've been looking very closely at this very recently to see if there were any gaps, any significant gaps in what we do. And I don't believe there are significant gaps. Can we do it better? Absolutely. Can we be more efficient in delivering the things we do? Yes, certainly. And can we do a much better job in articulating what it is we've actually done? And I would say there is no doubt about that. That is the area that we've probably arguably let ourselves down in so far as not getting on the front foot until recently to tell people the story. But I can assure you that that situation is about to change. Stuart said they published their report yesterday. Well, Jess is right onto that one, and come April there'll be another one on the streets. And I think it is important that we do get out and tell the story. And one of the key reasons for that is that a lot of investors look at ESG as a sort of quasi risk management tool. They say, if people are actually attending to these small details in their business, then there's a pretty good chance that they're managing the entire business well also. So that's another reason why we do, take it very seriously. And, I think that whether we like it or not, it is certainly here to stay. And clearly what, our fundamental objective is to leave the places where we work better when we go than what we found them. And I think if we, carry out the practices that we've got in mind, then we're certainly going to be doing that.
Richard, how difficult was it for you in West African to ensure that your ESG credentials were in place, making that move from explorer to developer to producer?
Yeah, I think it's a real challenge doing it, like as a single asset company coming through, doing a senior project facility. And backing up, we'd run a process in 2018 for project finance, and we had two groups. One was a group of banks, 4 or 5 banks in a syndicate, and Taurus ended up being the choice of the PE funds. And I'd say ultimately the only difference was we're dealing with one group at Taurus, not 5 different groups in a syndicate of banks. So the principles and the ESG requirements we've had to meet are probably no different. So there's been a huge amount of work done by our team and then also from the ITE, so the independent technical engineers who review all of the work on behalf of Taurus. A lot of backwards and forwards on that to see if there are gaps, because I agree with Jeff. Often it's and I'm obviously biased to exploration geologists because I think we're wonderful people, but we're already on the ground and we're there for years before you kind of break ground, before you start construction. So you've already got a relationship and a connection with the people on the ground. So you find out pretty quickly if your community's happy or not. And I've been part of some that have been very happy and some that are not happy. And you don't want to be there when they're not happy. So that's obviously it's a motivating factor to make sure that the people you're working with are getting a fair deal. the amount of work that's gone into it, like we'll have a expanded, commentary around sustainability and ESG in our upcoming annual report, and then we're also looking at a maiden ESG report coming out, probably later this year. So there's a huge amount of work that's gone into it. But I think what it kind of just documents everything as well, and it puts it in order, because I think we are generally doing it.
Great, thanks. Sounds like everybody's almost finished eating, and we haven't got much longer, actually. So has anybody got any questions? We've got some high-quality guests in the audience today. I'm sure there's some questions to be had. Do we have anybody to ask a question? Just me then, is it? Okay, thank you. I just received a text message about a question asking, we've seen a lot of M&A activity in Australian gold circles in the last 18 months. And we've also seen it in West Africa itself. We haven't seen any M&A activity from any of these companies up on stage. So the question is...
Sorry, Dom, we actually did acquire a project, and so is Jeff.
Yes,
so,
yes, I know, yes, I know. I'm talking producing
well,
assets.
We haven't actually merged or taken each other over.
Yeah, producing assets. Right. Producing assets. You haven't bought any producing assets. I should clarify.
You mean like the Mako asset?
Yeah, that's right. I said 18 months. Remember, this is a text message from me.
Oh, sorry. Yeah, I just wanted to clarify what you said.
Yeah, so the question is, when will the three of you merge, and is there a prerogative for it? And that's from a M. Connolly of Wembley. No, in all seriousness,
does he want to be chairman?
He would like to be chair of the company.
And he'd probably want to call it the Wolves of West Africa or something like that. Yeah.
No, in all seriousness, you all have certainly resolute of bought a producing asset. Perseus and West African have dabbled, shall we say, in M&A activity by picking up developing assets. We've seen big headline deals here in Western Australia and in West Africa for that matter. Is that M&A drum still beating in West Africa, and are you fielding interest either from each other or from outside parties? Jeff?
That's all right, I have to kill you, mate. No, look, I don't think a week goes by when I don't have an investment banker come visit me who says that you should take over Resolute, you should take over West Africa, or vice versa, or all the rest of it. So, look, it's exercising a lot of people's mind, but it's not quite as simple as that. There has to be, strong industrial logic for doing it, and there has to be, a meeting of the minds. And without both of those things present, then it doesn't happen. So it's a bit of a moot point. By the way, dabbling in M&A, I think, is a little bit harsh. I mean, Perseus did acquire Amara back in 2016 and did acquire Exor in last year, and as a consequence of the Amara transaction, we've now got one of the better projects in West Africa and Yaouré. But so it's not exactly dabbling, my friend. But
I did say 18 months.
Yeah, okay, fair enough.
Stuart, does the fall in the gold price perhaps make M&A and corporate discussions easier to have?
I'm not sure that it does. We've got to operate through any particular cycle. So, I think if you're looking at it from an M&A perspective, subject to the banker that knocked on Jeff's door and came to see me, it's all about how you bring all of those assets together, and you if you like, you continue to trade those assets. I think that's what's really important. You've got to make sure that you're always putting yourself in a better position. It's pretty obvious, isn't it? A better position after than where you were before. So that's obviously what's important, and it exercises everyone's mind on a very regular basis. So
I think it's always easy for bankers to suggest things because they're going to get a fee out of it. The reality is, as operators, you're wedded to that business, and you've got to make it work, and you've got loyal staff. You've put years of hard work into it, and I can talk in my situation. We've got our company in a position now where everything's operating really well. We've hired well. We've got a really functional board, which I'm really happy with. And so there's a lot of things that, and I think we've got a really good shot at growing this business organically as well. I don't think from West African's perspective we've maximised value yet. Like, we only got our updated life of mine plan out last week, and so I've still got to go and get on the Zoom and do some marketing and sort of promote our company. I know Jeff's still ramping up the RA as well. So there's, and I know, and you've got to deliver on Syama, which is, had its challenges, and it's important. So I think we all see that there's value, and I'm sure every CEO says, like, I'm undervalued and he's overvalued or she's overvalued. So I prefer to kind of wait until my share price is higher. And the reality is you just got to keep pushing on and worry about the business and don't worry about the bankers, as far as I'm concerned.
Jeff? I think there is one reality, though, that does sort of speak in favour of the merger kind of scenario, and that is that, of course, these days there's a lot of passive money out there looking for homes as opposed to active money, which there was previously, and that passive money does tend to favour scale, particularly, if you look at, as everyone would realise about, GDXJ and GDX, these sort of things, and I think that, the bigger you are and more productive you do, attract that money. So there is some merit to that particular argument, I think, in terms of size. But look, at the end of the day, it's all about making money, and scale doesn't actually make you more money necessarily. And as I say, to justify doing it, the relative valuations has to be right. There has to be strong industrial logic, and people have to be, similarly minded in the way they approach it. So, look, these things come and go, and fashions come and go. Let's watch this space.
I think scale and diversification in terms of location, that's another point we shouldn't forget about either. I think that's important.
That is a really important point, particularly working in the West African scenario. I mean, we've found this absolutely, having multiple mines, multiple jurisdictions does spread risk and does make you more attractive to risk-averse investors. And, we talk about West African discount and things like that. I think the fact that if you do have that risk spread over a number of operations and domiciles, then you're certainly considered to be less risky. So there is definite merit in what Stuart is saying there.
Richard, was that the rationale behind picking up a second asset at a time when you were still ramping up? Were you very conscious of being a single asset company?
Yeah, there's been other single asset companies that have developed and probably, maybe spent a bit of time, I guess, basking in the glory of doing like discovery and then, building a project and pouring gold. But really there's no time to waste for that sort of thing. We had to backfill our schedule. The acquisition from B2 Gold of Toega was an opportunity for us to certainly backfill the middle part of our project life. We had to make a decision in 2018. You're kind of balancing how much cash you've got available to keep the market interested, to keep generating good drill results, so you can go and raise the big whack of money you need to develop the project. And we stopped drilling in 2018, and we didn't drill at all during the construction period, really, on anything that was going to add mine life. And then, obviously, last year, once we'd got through the build and we started producing, and we had a bit of money left over, we got sort of busy with drilling out the high-grade shoot at M1 South. And thankfully, the dozen holes that we put into it all came back with, or most of them came back with really solid results, and it backed up the thesis that this high-grade shoot goes from surface down to a kilometre, which it does. And that's also, in our recent update, we've managed to backfill that life of mine schedule, which, now obviously it looks a lot better than what it did when we finished the feasibility study and built the project in 2018-19.
Great, thank you, Richard. Have we got any questions? We've got time for probably one, maybe two. Not at all. Well, we have gone over time anyway, so it's, maybe they're telling us that we should stop talking. Well, thank you very much, ladies and gentlemen. Thank you to our panellists, Stuart, Richard and Jeff. Maybe we can give our panellists a round of applause to begin with. Now, we usually have a business card draw. I'm not sure that we have one this month, do we, Mel? No? Oh, well, we did get donated a prize of a lovely bottle of Shiraz Grenache, and the person who donated it said I should present it to the best panellist. So, Jeff, there's a lovely bottle of Daleview Shiraz Grenache from one M. Connolly, I think his name is again. So,
it's not bad. I've had a
so
box.
well done, Jeff, on winning it as our best panelist of the day. Ladies and gentlemen, thank you very much for joining us today. Please stay and have a drink. Yes, please. The drinks will keep flowing for the afternoon. Coverage of this event and also the rest of the industry will be in the next edition of Paydirt, which will be out, well, we go to print today, depending on how many glasses of wine we have straight afterwards. So it will be out late next week. The latest edition of Gold Mining Journal, which features the chat between myself and Leanne and Jess as well, will be out next week as well. So look forward to that. And other than that, we're not opening the doors until you've all signed up for Africa Down Under. So thank you very much. Enjoy yourself, and we'll see you again next month when our topic will be WA gold exploration. So we're back on a domestic front. And the following month in May, we're going to turn our attention to uranium. So John Borshoff's in the room. So if you want a little bit of a head start, I'm sure John will talk you through a few bits on uranium. Thank you very much.